I was sitting in my office at Oaktree last Tuesday when I pulled up the retirement account statement of someone I've known for 20 years. Smart person, successful career, 53 years old, and looking at a retirement crisis that didn't need to happen. The numbers told a story I've seen too many times. Not a story of bad luck or market crashes or unforeseen catastrophes. A story of four specific decisions. Decisions that seemed reasonable at the time that had quietly destroyed what should have been a comfortable retirement. Here's what troubles me. These weren't reckless decisions. They were the kind of choices that sound prudent when you make them, the kind that financial advisors sometimes recommend, the kind that your friends are probably making right now. But after managing money through 7 major market cycles, after building Oaktree into a firm with over $170 billion in assets, after watching thousands of investors navigate the final stretch before retirement, I can tell you this: if you're over 50 and you make these 4 mistakes, you're not just reducing your retirement income, you're fundamentally changing what your retirement will look like. And unlike mistakes you make in your 30s or 40s, you don't have time to recover from these. So I want to walk you through each one, not with theory or textbook principles, but with what I've actually observed, the patterns that separate investors who retire with confidence from those who retire with regret. The first mistake: believing you can make up for lost time with higher returns. Let me tell you about a conversation I had in 2021. A 56-year-old executive came to see me. He'd spent his 40s building a business and hadn't saved much for retirement. Now he had some capital and wanted to catch up. His plan? Put everything into high-growth tech stocks and cryptocurrencies. I need to take more risk, he told me. I'm behind. I asked him a question. What happens if you're wrong? He didn't have an answer. Because he was thinking about returns, not risk. He was thinking about what he could gain, not what he could lose. And that's the trap. When you're over 50, your relationship with risk changes fundamentally. Not because you're older, because your timeline shrinks. A 30-year-old who loses 40% in a market crash has decades to recover. A 55-year-old who loses 40% 5 years before retirement? That's a different situation entirely. I've watched this pattern destroy retirement plans more than any other single mistake. Someone realizes they haven't saved enough. They panic. They reach for higher returns. They take concentrated positions in speculative investments. And then, because markets are cyclical and risk eventually finds you, they lose capital at precisely the moment they can least afford to lose it. The math is brutal. If you lose 40% of your portfolio at age 57, you need a 67% gain just to get back to even. And you need it before you retire. That's not a plan. That's a prayer. What I've learned over 5 decades is this: the investors who successfully navigate their 50s aren't the ones who swing for the fences. They're the ones who understand that preservation of capital becomes more important than growth of capital as retirement approaches. Does this mean you shouldn't take any risk? Of course not. I'm not suggesting you put everything in treasury bills, but there's a profound difference between taking calculated, diversified risk and gambling your retirement on concentrated bets because you're, quote, behind. Right now, in 2025, I'm seeing this mistake everywhere. People who didn't participate fully in the market recovery are looking at friends who made money in AI stocks or cryptocurrency and thinking they need to catch up. They're abandoning diversification. They're concentrating portfolios. They're taking risk they don't understand because they feel they don't have a choice. But you always have a choice. And the choice that preserves your ability to retire comfortably isn't the one that promises the highest returns. It's the one that protects you from catastrophic loss. I tell people in their 50s, your goal isn't to maximize returns. Your goal is to arrive at retirement with enough capital to support the life you want to live. Those are different objectives. And confusing them is the first mistake that derails retirement plans. The second mistake: underestimating how long you'll live. In 2008, during the financial crisis, I had a client who was 62 years old. He wanted to retire immediately and start drawing down his portfolio. His reasoning? My father died at 68. I don't want to work until I drop. I understood the emotion, but I asked him to consider the data. Life expectancy for a healthy 62-year-old male in 2008 was about 84 years. His father's early death was tragic, but it wasn't predictive. He retired anyway. He's 79 now, and he's been living on a reduced budget for the past 7 years because his portfolio wasn't designed to last this long. This is the mistake I see constantly. People plan their retirement finances based on average life expectancy, or worse, based on family history. But averages are misleading. Half of people live longer than average, and if you're healthy, educated, and have access to good health care, which describes most people reading this, your odds of living into your late 80s or 90s are substantial. The financial implications are staggering. If you retire at 65 and live to 90, your portfolio needs to support you for 25 years. That's not a short-term financial plan. That's a quarter century of expenses, healthcare costs, inflation, and market volatility. And here's what makes it worse. Your expenses don't decline linearly as you age. Healthcare costs typically increase dramatically in your 80s. Long-term care, which most people don't adequately plan for, can cost $100,000 per year or more. The assumption that you'll spend less in your 80s than your 70s is often wrong. I've spent considerable time thinking about this problem because it's not just a financial planning issue, it's a risk management issue. And risk management is what I do. The question isn't how long will I live, the question is how long might I live? And the answer should incorporate a margin of safety. If you think you'll live to 85, plan for 95. If you think you'll live to 90, plan for 100. Does this mean you need more capital? Yes. Does it mean you might leave money on the table if you die earlier? Yes. But I'd rather have clients who die with money left over than clients who run out of money at age 85 and have to dramatically reduce their standard of living. Right now, in early 2025, medical advances are extending life expectancy faster than most financial plans account for. The 70-year-old today is healthier than the 70-year-old of 20 years ago. Longevity risk, the risk of outliving your money, is increasing, not decreasing. Yet I consistently see retirement plans that assume 15 or 20 years of retirement. That's not conservative, that's optimistic. And optimism, when it comes to retirement planning, is dangerous. The investors I know who are most comfortable in retirement aren't the ones who accumulated the most wealth. They're the ones who built portfolios designed to last longer than they expect to live. They accepted that they might not spend every dollar. They prioritize security over maximization. That's the mindset shift that needs to happen in your 50s. From how much can I accumulate to how do I ensure this lasts as long as I do? The third mistake, failing to account for sequence of returns risk. This one is subtle. Most investors don't understand it until it's too late, but it's devastated more retirement plans than almost anything else I can think of. Here's the concept. The order in which you experience investment returns matters enormously when you're withdrawing money from your portfolio, and it matters most in the years immediately before and after retirement. Let me show you what I mean. Imagine two investors, both retiring with $1 million. Both earn an average annual return of 6% over 20 years. Both withdraw $50,000 per year. But investor A experiences strong returns in the first decade and weak returns in the second. Investor B experiences weak returns first, then strong returns later. Who ends up with more money? Investor A, by a wide margin. Why? Because Investor B was forced to sell assets at depressed prices early in retirement to fund withdrawals. Those assets weren't available to participate in the later recovery. This is sequence of returns risk. And if you're over 50, it's one of the most important risks you face. I watched this destroy retirement plans in 2008-2009. People who retired in 2007 or 2008 and started withdrawing from their portfolios had to sell stocks at the worst possible time. Even though markets recovered strongly after 2009, many of these retirees never recovered because they depleted their portfolios during the downturn. The same thing happened in 2000-2002. Retirees who experienced the dot-com crash early in retirement had dramatically worse outcomes than those who retired just a few years later, even though both groups experienced the same market conditions over time. What makes this particularly insidious is that it's not about average returns. You can achieve your target average return over 20 years and still run out of money if the sequence is wrong. The math works against you when you're making withdrawals during market downturns. So what do you do about it? This is where my thinking has evolved over the years. The traditional answer is to reduce equity exposure as you approach retirement. That's not wrong, but it's incomplete. What I've found works better is building what I call a retirement buffer, a portion of your portfolio in stable, liquid assets that can fund 3 to 5 years of expenses without forcing you to sell stocks in a downturn. This might be short-term bonds, money market funds, or other conservative investments that won't lose significant value in a market crash. The logic is simple. If you retire and markets immediately decline 30%, you don't want to be selling stocks to fund your living expenses. You want to draw from your buffer, let your equity positions recover, and replenish the buffer when markets rebound. This isn't about market timing. I don't believe in market timing. This is about creating optionality, giving yourself choices when markets are volatile, instead of being forced to sell at the worst moment. In 2025, with equity valuations elevated in many sectors and interest rates still providing some yield on conservative investments, building this buffer makes more sense than ever. Yet I see retirees with portfolios that are 70 or 80% in stocks with no consideration for sequence risk. They're optimized for returns, not for the reality of retirement withdrawals. The investors who navigate retirement successfully understand this. It's not just about how much you make, it's about when you make it. And protecting yourself from poor early returns is as important as achieving good average returns over time. The fourth mistake: ignoring the impact of inflation over decades. Let me take you back to 1975. I was a young investor, and inflation was running at 9%. I remember older investors telling me it was temporary, that inflation would come back down to the 2 to 3% range and stay there. They were right, eventually, but it took nearly a decade. And the investors who didn't protect themselves against inflation during that period saw their purchasing power erode dramatically. Fast forward to 2021-2023. Inflation surged again, and I heard the same conversations. This is temporary. It'll come back down. Don't worry about it. Maybe it will moderate, maybe it won't. But here's what I know after 50 years of watching inflation cycles. If you're planning a retirement that could last 30 years, inflation isn't a minor consideration. It's an existential threat. The math is straightforward but often ignored. At 3% inflation, your purchasing power is cut in half in 24 years. At 4% inflation, it's cut in half in 18 years. If you retire at 65 with what feels like adequate income, by age 85, that same income buys half as much. Think about what that means practically. If you need $80,000 a year to live comfortably today, you'll need $144,000 in 20 years just to maintain the same lifestyle, assuming 3% inflation. If inflation runs higher, say 4%, you'll need $175,000. Most retirees don't plan for this. They look at their current expenses, add a small buffer, and assume that's what they'll need throughout retirement. But inflation compounds silently in the background, gradually eroding purchasing power until suddenly, 10 or 15 years into retirement, they realize their fixed income doesn't cover what it used to. I've seen this pattern repeatedly. Retirees who were comfortable at 65, struggling at 80, because they didn't account for cumulative inflation. Their pensions, if they have them, often don't adjust for inflation. Their Social Security does adjust, but not fully. And if they're living off a fixed portfolio withdrawal rate, they're losing ground every year. What's the solution? It's not complicated, but it requires discipline. Your retirement portfolio needs growth assets, stocks, real estate, inflation-protected securities, that can potentially outpace inflation over time. You can't be entirely in bonds or cash, even in your 70s and 80s, because those assets will lose purchasing power. This creates tension with the other principles I've discussed. I told you not to take excessive risk. I told you to build a buffer of conservative assets, and now I'm telling you that you need growth assets to combat inflation. How do you reconcile these? The answer is balance and diversification. Not the kind of diversification that's just window dressing. Real diversification across asset classes, geographies, and strategies. A portfolio that has enough stability to weather market downturns, but enough growth potential to outpace inflation over decades. Right now, in 2025, I'm particularly focused on this because we've just been through a period of higher inflation. Some investors think it's over and they can go back to conservative portfolios. Others are so worried about inflation that they're taking excessive risk. Both groups are making mistakes. The right approach, in my view, is to build a portfolio that can handle multiple scenarios. Not a portfolio optimized for one view of the future, but one that can survive and potentially thrive across different inflation environments. That means some exposure to stocks, some to real assets, some to inflation-protected bonds, and yes, some to stable, liquid investments for near-term needs. What I've learned is that retirees who successfully navigate 30-year retirements don't have portfolios that look dramatically different at age 85 than they did at 65. They maintain balanced, diversified portfolios throughout retirement because they understand that inflation is a long-term threat that requires a long-term solution. Putting it all together. These four mistakes, reaching for returns, underestimating longevity, ignoring sequence risk, and failing to account for inflation aren't independent. They interact, they compound, and they're particularly dangerous for investors over 50 because time is no longer on your side. What strikes me after decades of watching investors navigate retirement is how often the mistakes are subtle. They're not obvious errors. They're reasonable-sounding decisions that seem prudent at the time. That's what makes them so dangerous. The executive who decides to take more risk because he's behind. That seems logical. The retiree who plans for average life expectancy. That seems reasonable. The person who builds a conservative portfolio without considering sequence risk or inflation. That seems prudent. But reasonable and prudent aren't the same thing. Reasonable means it makes sense on the surface. Prudent means it accounts for what can go wrong. And that's the fundamental shift that needs to happen in your 50s. From optimizing for what might go right to protecting against what could go wrong. From seeking the best possible outcome to ensuring an acceptable outcome under a wide range of scenarios. I don't know what markets will do over the next 20 years. I don't know what inflation will average. I don't know how long you'll live or when the next bear market will occur. Nobody does. But I do know this. The investors who retire successfully aren't the ones who predict the future correctly. They're the ones who build portfolios that can handle multiple futures. They accept that they might leave something on the table in exchange for sleeping well at night. They prioritize sustainability over maximization. That's not exciting. It won't make you rich quickly. But after 50 years of watching investors succeed and fail, I can tell you it works. And working, when it comes to retirement, is all that matters. You're over 50. You've worked for decades. You've accumulated capital. The question now isn't how to get rich. The question is how to stay that way. How to convert what you've built into a retirement that lasts as long as you do, that maintains your standard of living, that gives you security instead of anxiety. Avoiding these 4 mistakes won't guarantee a perfect retirement, but it will dramatically increase your odds of a good one. And in a world of uncertainty, improving your odds is the best any of us can do.